And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. It's, of course, Monday as we get ready this week, right? We're going to kick off really the big bulk of earnings. They started kind of trickling in a little bit last week, mostly regional banks, major banks. And today's kind of the same, more of those banks. But starting really this week and moving into next week is all the big companies, right? Apple, Microsoft, Google, Amazon. We are about to get hit over the next really couple of weeks with about 80% of the S&P 500 will all report earnings. So we're about to get into it very, very quickly in terms of seeing just how good these earnings are. Estimates have been lowered dramatically. So again, that bar is set very low. So expect a lot of beats. That certainly won't be surprising here. That's also been helping fuel this market here over the last few days. Of course, big news on Friday. We'll talk about this some more in a minute when we do our before the bell wrap. Markets hit an all-time high, and we'll talk about the implications of that. But outside of that, overall, what we've talked about before, and this is very important, and is that back in 2010, when Ben Bernanke was Fed chairman at the time, just as we were launching the second round of quantitative easing, so coming out of the financial crisis, we did QE1. That ended in June of 2010. Then in September of 2010, we launched QE2. And at that time, at the FOMC meeting, Ben Bernanke said, well, the reason that we're doing this is that higher asset prices, and again, this is why we know that QE does affect the market, because Ben Bernanke told us, higher asset prices boost consumer confidence, which leads to stronger rates of economic growth. So there you go. People feel better when asset prices go up. That's not surprising. And interestingly enough, not surprising, consumer confidence index is out last week from the Conference Board and showing just very drastic, University of Michigan, showed very drastic increases in consumer confidence. Not just, and this is not just, current asset prices, right? And their current confidence right now not only jumped sharply, highest level in 2.5 years, but it was also future expectations, their financial situation. Expectations for home prices have increased sharply. Retirement income is at a new height. So retirees expecting better retirement income now is at a new high. So all of a sudden, this rally just really since November has done a drastic turn in consumer confidence. It's just across the board, people are feeling much better. Now, of course, that should get people out spending more money. We saw retail sales on Friday, showing that, or last week, but retail sales were decent in December. And again, really no sign of an economic slowdown, economic recession at this point. And now this big jump in consumer confidence also suggests that there's really no risk of a recession, at least not now, because consumers are feeling very good about themselves, and with more money in the bank, they're certainly going to go out and spend that money. Now, whether or not they actually do that, we'll see. But again, there is certainly a big boost in consumer confidence. And this is all, now what's fascinating about all of this is that this is all a function of just guesses that the Fed is going to start cutting rates and doing QE again, right? We haven't even done it yet, right? We haven't even done QE yet. We haven't even cut rates yet. And already consumers are, in markets in particular, are very, very optimistic. In fact, consumer expectations for higher stock prices over the next year jump sharply as well. So again, there is just really optimism across the board from these indexes. We're even seeing it from the National Association of Business. That is, just increases there. The NABE report just came out. Optimism on the rise across the board. So this last 2 years of drudge and disappointment looks to be, at least at this point, behind us. Doesn't seem to be, as inflation's coming down, things are improving economically. People are feeling a whole lot better about themselves. And that's translating really into optimism from both the individuals as well as the business side of the component. So, again, we'll see what happens as we get further into this year. But again, right now, it's kind of, all engines on deck moving forward at this point. So it's just, we're just doing very well. But here's what you need to know before the bell. So good news, bad news. On Friday, good news, of course, on Friday, markets registered a new all-time high. So again, this has gotten everybody very excited here. Markets are pointing higher this morning. Again, not surprising. Once you set a new all-time high, you're likely going to repeat that here because you just get a lot of momentum going. And we've had a lot of momentum in this market really ever since those those October lows from last year. Market's still doing very well here. Now, here's the interesting point. A lot of people talk about, just buy and hold an S&P 500 index. That's fine. But here's the issue with that. We are now back after 2 years, almost to the day, a little bit longer, but with a 0.9% increase in the markets from where we were 2 years ago. So yes, while we've had a tremendous rally really from the lows of October of 2022, markets have done very well here. But we have just been spending a lot of time getting back to even on a buy and hold basis. So now the bad news, of course, is if you were needing 6% a year, there's still 12% we still have to make up from here. So we just now got back to making money after 2 years. But nonetheless, markets are registering new highs. New highs tend to beget new highs. The question is how much higher are we going to go? And again, we have to, at some point, begin to talk about fundamentals, valuations, etc. But at least right now, none of that's kind of all in the rearview mirror. We still are running a MACD sell signal very, very high. That's about to flip back to a buy signal. The problem with that is that you're flipping back to a buy signal at a fairly high level, which that can occur. And we saw this previously back in June and July. Market was making an advance. We had a sell signal early. Market flipped back to a buy signal from a high level. The market rallied some more. Not a huge rally, but then we got the next sell signal and you had that 10% correction. We're likely going to be set up for some event like that, because we've had a very, very strong rally here ever since November lows. And again, this could last for another month or two. But again, we kind of flipped back to a buy signal here. We're already back to overbought conditions again. So that little bit of work off of that overbought condition has already been reversed. So we're moving back into overbought conditions very quickly. You've got a very high level MACD at this point. Suggests that yes, upside here is likely going to continue at least for the could be next week, next couple of weeks, next month, particularly as we have earnings coming in. That's likely going to support this because we'll have companies coming in, they're beating estimates, even though they're lowered, but it's good news. So markets kind of grind their way higher. But then after that, we're likely going to be set up here for another leg of a consolidation or a correction over a period of time. So again, doesn't mean you shouldn't take advantage of this. Yes, right now, increase some equity exposure. We're breaking out. If we get a good confirmation of this breakout over the next day or two, in other words, the markets hold it this week, no reason not to increase some equity exposure here near term as markets continue to rally up here a bit. Kind of, again, it's momentum, it's excitement. Once you kind of break out to new highs, that tends to beget new highs. So go ahead and participate with that, but be a little bit cautious here. Just realize markets are very overbought and you're going to get some type of correction at some point, which will give you a better opportunity to further increase exposure then. So again, a little bit of trading here. You can take some advantage of this, but don't forget to sell some along the way as well. Take some profits as we get there. That's what you need to know before the bell this morning. When we come back, lots of stuff to get into. And again, we'll kind of start talking about what's coming up this week as we kind of get into this and talk about the rest of the things going on within the economy. Stick around. More of the Real Investment Show coming up right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts, Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere, Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. So again, good news this morning. Markets are going to be up. S&P is currently up about another 16 points this morning. NASDAQ up 115. And, of course, the Dow is also up. So basically you have all your indexes. And we talked a little bit about this last week. In fact, when I told Brent the title of the show this morning, he's like, we said that last week. I said, well, now it actually happened. Because we talked about the fact that with the NASDAQ hitting all-time highs, it was just a function of time until the S&P hit an all-time high. It's, when you're close to all-time highs, it's like a magnet, right? And it's just markets want to get there. And, of course, once you get there, then it's kind of everybody gets all excited that you're at a new all-time high. And so it kind of just, again, it kind of feeds on itself here a bit. So you kind of get this, big jump in exuberance and confidence and, things are great and, the bad times are behind us. And look, and that's a true statement. If we go back and we look over the last 2 years, a lot's been going on. You had the invasion of Ukraine and we were coming out of the pandemic and all those type of things that were going on were associated to the whole pandemic issue. Lots of concerns about inflation, and that was followed by, what's happening in Israel. I mean, it's just been just one kind of catastrophe after another that's been going on, and yet the markets have weathered all this very, very well, relatively speaking, right? I mean, the markets were down 19% in 2022, but recovered all of that in 2023. So here we are in 2024, all-time high. And so certainly, you go look back and you think about all the angst. And we were talking about so much of that here on the show, right? There was so much angst out there about whether it was the political environment or the economic environment or whatever it was. We're like, hey, just, be careful with this because markets will do stuff that doesn't make a lot of sense. And, you got to be careful with these kind of big macro theses. Remember the whole, we spent, a couple of months here talking about the death of the dollar. And it was concerned that, that was going to destroy everything at that point. We're like, hey, just be careful with this. This is, kind of not the way that works. And again, here we are at new all-time highs. And look, you may not like it, but the fact is we're here. And valuations are still problematic. Earnings growth is, anemic at best at this point, at least for fourth quarter. And we'll see if all this can actually turn around. All this has to do with a lot of liquidity that's been coming into the markets and the economy, right? And that's still coming. We haven't changed any of that dynamic yet. And so these are the things that we have to, kind of watch and pay attention to as the markets respond off of that. And as I said, as markets go up, that increases confidence, which fuels economic activity, which further boosts asset prices. So, you're caught in this kind of a cycle here. So my conversation here is be careful being overly bearish at this point, because there's really no reason to be overly bearish right now. But look, we can certainly kind of go through some bearish backdrops, right? Small caps are not performing. They're not anywhere near all-time highs. If you take a look at the breakout of all-time highs, and I touched on this weekend in the newsletter, which is on the website now at realinvestmentadvice.com, that we're back to the mega cap rally. The S&P market cap weighted index is up this year, about 1.5%-ish. But the equal weighted index, which strips out some of the impact of those big mega, they're still in the index on the equal weighted basis, but they're not as big of a component. That's not doing nearly as well. There's about almost a 2% gap between the performance of those two indexes. So again, we're seeing this very narrow rally at this point. Small caps not performing, international emerging markets really not doing that well. But it's this chase for technology, the big mega caps, AI, and it was interesting because, there's this whole issue going on in Davos right now, and they're talking about some of the topics that are coming out of there, from the CEOs of these companies talking about the next AI. I thought there was an interesting comment that Salesforce co-founder and CEO Mark Meinhof said that he sees a world of digital people taking shape. And that's kind of an interesting fact. That's going to be the case. Right now there was an interesting article out over the weekend, and it was listing 10 jobs that you can have right now where you don't have to talk to people, which there's a lot of people that want that job, right? I don't like people either. So if I could have a job where I don't talk to people, it'd be great. But, one of those was working for a company dealing with their chat, their live chat, right? So you just sit behind the screen and answer people's questions through live chat. It's interesting because we've talked about this before, that technology is really great to a point. We can increase productivity using technology. And we assume that increases in productivity lead to better economic outcomes. But is that really the case? And we've gone through these examples before. We take a look at the average American, look at disparities of income and those type of things. And there is a direct correlation between increases in productivity and less economic prosperity. And, we've gone through examples before. How many companies do you go to now? One of our things here at RIA Advisors is that we really pride ourselves on customer service and being very interactive and talking to people and having somebody actually answer the phone. So if you call, somebody actually answers the phone. Unless it's after hours, obviously, or everybody's busy, you might get a voicemail at that point. But most of the time, somebody's going to pick up the phone and answer your question. And what's interesting is how many companies do you call today where when you call the front desk of that company, somebody picks up the phone? Or are the vast majority of companies that you call, the first step is press 1 for English, press 2 for Spanish, right? And then you start going through the tree to get to where you want to go. Yeah, and everybody's like, all right. And I was like, yeah, it's terrible. But back in the day, right, the receptionist was a very, very important role for every company. They were the first line of offense for the company. So when that prospect or that lead or that question came in and it hit the front desk, and she was the one, he was the one, whoever it was at the front desk, were taking those calls and routing them to wherever they needed to go, right, on a live basis. And that was a very important job. Those jobs don't exist anymore because of why? Technology. And we can just go down the list. How many jobs have been lost? And that impacts, robotics have impacted, and technology, I shouldn't say just robotics, but robotics, technology have impacted every business. We've replaced spot welders with robots for car manufacturers. And, you can't really find a job or somewhere in the environment where jobs have not been reduced. I shouldn't say lost, because they're not lost, right? I just don't need as many people. I used to be able to do this job, and we've talked about even running the radio show here that, 20 years ago, it would take 5 people to run a show like this. Now we do it with 2. And that number may be 1 at some point. If I can figure out how to do everything myself, we can get it down to 1. Technology, robotics and AI may take the place of Brent at some point. I'm not sure how, but I'm just saying it's possible. And so we all, and the thesis behind this is always very simplistic, which is, well, just because Brent lost his job to AI, that just gives him time to go do something else, right, where he can make more money. The problem is that AI is going to replace jobs everywhere. And unlike a lot of technology that replaced very kind of support type roles, again, we all lost receptionists because we had automated phone services. Now, theoretically, that person was smart and went back to college, got a law degree, and became a lawyer, right? And so that person, because that person didn't, this is the thesis, right? And this isn't true, but this is the thesis, is that as technology replaces jobs, then those people go get better jobs. Or the other thesis is, well, somebody's got to maintain the artificial intelligence. Well, not everybody can go out and go get jobs, programming artificial intelligence. There's a limit to those jobs, limit to every job. This was one of the key arguments with the development of the internet back in 1999, 1998. But when Brent and I were doing the show back then, we had plenty of conversations back then about, we were watching people graduate college at that point, and they were website programmers, and they were getting offered $300,000 jobs to come program websites, getting cars, big signing bonuses, you name it, because there was such a high demand for people to program websites and write the code for them. And so everybody started doing that. People were losing people lost their jobs because of the internet, and they became web programmers. And as more and more people became web programmers, those salaries declined because it's always supply and demand. So artificial intelligence and the idea of digital people taking shape sounds great, but now we need to start talking about the displacement of jobs that occur because of digital people. And the thing about AI is that it's not going to be just receptionists that gets replaced. AI is infiltrating engineering, computerization, lawyers, architects, accounting. Your highest wage paying jobs are being impacted by productivity increases from artificial intelligence. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Kids these days, they're always inventing something new. So have you heard about this new thing called Scrawlish? Scrawlish. It's a new way to write.
The Real Investment Show podcast.
So yeah, it uses a set of symbols to represent letters. And that way you can theoretically write faster, right? Take notes. It's very cool looking on paper and nobody can read it.
At realinvestmentadvice.com.
It's also called shorthand. We developed that like 50 years ago.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell Report, Financial Fitness Friday, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So just talk a little bit about, this kind of very interesting article talking about AI, because obviously this is, as markets are hitting all-time highs, this is really all about the companies that can, really take advantage of artificial intelligence, right? Companies like Amazon, Microsoft, Apple. These are the companies that Salesforce, which is the CRM company. These are the companies that will be able to take advantage of and use artificial intelligence in its kind of early stages, and it continues to develop. It will just start to infiltrate more and more into the economy. And this is going to be, there's really nothing to stop this coming. Of course, knowing this is happening, I spent all weekend watching all the Terminator series just to get all my facts together for the show this morning. But, there's really nothing to stop the development of AI at this point. It's here. It's been here for over a decade. It's just now really coming to the forefront. We're now really starting to see the impact of it. And, of course, the companies that are driving that development, companies like NVIDIA, AMD, Google, others, obviously being reflected in people piling money into those companies right now. And we're seeing those asset prices drive higher. And the whole purpose of this conversation was to, which I digressed a bit, was simply what's driving the market currently. And that doesn't seem to be changing here in the near term. because of a couple of reasons. One, we have the passive indexing effect that we talked about before. So every time somebody just, oh, the S&P is hitting a new high today, I'm going to buy more S&P index fund. Well, 35% of every dollar goes into those stocks that are the biggest market cap in the index. So you have that factor. You have the passive flow factor that is driving markets higher. The second reason, of course, is that these same companies, Apple, Google, Microsoft, NVIDIA, they're so large and they're so liquid that as for hedge fund managers, for pension funds, etc., if I just buy those stocks, I will get a big chunk of the S&P performance, up or down, because there's such a large weight in the index. What they do drives the overall index. So I can hide there. I can get index performance, and I can hide in stocks that are highly liquid. So they're easy in, easy out. If I need to get my money out very quickly, I can do that without moving the price of the stock much. I can move billions of dollars in and out of these companies, and it doesn't affect the market that much. Can't do that with small cap companies. Then there's also the buyback effect. Small cap, mid caps can't buy back shares to improve earnings. Large companies can. So from a portfolio management standpoint for pension funds, hedge funds, mutual funds, etc., these are the companies that are easy to put money into. Now, none of that has to do anything with valuations, right? We don't care about valuations at this point. Valuations are passé. Valuations, sure, they matter, but not right now, not in the short term. And we've become a very short-term focused market. Everything that we do right now is based on this week, next week, this month, this year, not 5 years from now. Because everyone has become very short-term focused. Individual investors, they don't look out, hey, I'm going to buy this stock for the next 10 years. They're like, I'm buying this stock for today, next week, and if it works, great. It's going up, I got to buy it. Average holding time, less than 5 months, and that's getting worse. I mean, I'm sure that probably in the next 10 years, the average holding time for a stock will be less than a month. I'm just, we're just slowly heading in that direction. We've just turned the markets into a very big casino, and that's okay. There's nothing wrong with that. You just need to understand the animal you're dealing with. So, as we look at, how the market is operating, right, and how things are occurring, this makes it more difficult to run a well-diversified portfolio. And, a lot of the old rules that we lived by in the 80s and the 90s, and we talk about Markowitz, we talk about, Buffett and these guys that were buying value and buying these things and expecting long-term holding periods. That doesn't work anymore. Now, it should, right? Valuations should matter. They just don't right now. Because if valuations mattered, people would be paying 30 times sales for a company. But we do it every day because we have to. Because markets are going up, and those are the stocks that are going up, so I have to buy those companies. That's just the way the market works right now. And there's nothing wrong with that. You just have to recognize it for what it is, right? And manage the risk accordingly. It's just a different market. This isn't your grandfather's market anymore, right? This isn't the market where valuations and fundamentals matter. They haven't mattered for a long time. Why? Because we've had $43 trillion worth of liquidity poured into the markets over the last decade. It's changed the game. Now, at some point, that may change again, right? We may stop injecting the markets with we may not be able to inject the markets with massive amounts of liquidity at some point. At some point, we may get a change in the administration that says, hey, you know what? We need to be fiscally responsible for a change. That's not great for the markets. Austerity is not good for the markets or the economy, mind you, right? And this is why nobody wants to do it, as we've talked about before. If I want to get elected, I don't want to do austerity. In today's media, such things as talking about austerity and fiscal responsibility are fascist, right? We can't do that. We have to do things that divert and redistribute tax dollars, which are not good long term. They don't create economic prosperity. And, it's a fascinating sociological experiment that we're in right now, because we're doing the very things that reduce economic prosperity for the masses. We see a lot of clear tension within the overall economy between the haves and the have-nots. But we keep doing the same thing, right? Because it boosts the stock market. And at some point along the way, and this really began probably under the Clinton administration, is that we began to equate political success with stock market success. If the stock market's going up, I'm doing a good job as president. Stock market's going down, I'm not doing as good a job as president. And that's where we kind of lost our way. Instead of doing what was economically right, we started doing what was economically easy. And so we have these discussions now about debts and deficits and all that. And they're great conversations to talk about the surging deficit. In fact, we wrote a whole article on Friday how deficit spending is keeping the economy out of recession. Just had a massive surge in the last quarter of the year in the deficit. Lots of expenditures coming into the economy, falling tax revenues. And there's a clear indication, that there's a disconnect. Economy's doing great, tax revenues are falling. Where do tax revenues come from? Tax revenues come from the income generated by individuals and corporations. So if those are falling on an annualized basis, there's something going on within the economy. In other words, people aren't making as much income, even though the economy seems to be, on the surface anyway, doing well. How is the economy doing well? That's the deficit spending, and as Greg is going to talk about this coming Saturday, which if you haven't gotten your tickets for the summit this Saturday, I encourage you to get by the website and do it. There's a few left. But he'll be talking about the fact that a lot of these cities and municipalities have not spent all the pandemic money yet. That's still there. And those projects, those shovel-ready jobs, like President Obama said, shovel-ready is not so shovel-ready. A lot of those shovel-ready jobs are just now starting to come online. We're seeing the CHIPS Act is leading to semiconductor plants being built in North Carolina and other places. Those take years. Got to develop them, design them, construct them, get them operational. It takes years. So that activity, those jobs that it creates doing that, creates economic activity. The problem, of course, is that what happens once the building's built and the people are hired? Yeah, we created some jobs. Great. But once it's done, that economic activity goes away. The demand for those construction goods goes away, right? It's done. It's built. And but we're still left with the debt that was used to fund it. And so we've got to keep servicing that debt, even though we don't have the economic activity coming from those dollars that we borrowed to build it. And this is the problem with all of this spending that we've done, is that at the end of the day, it's non-productive investment. And we still got to service the debt. All right, enough of that. When we come back, get ready to wrap up the show. I'm trying to find an article I wanted to talk to you about this morning, but I haven't been able to. I've lost it. So if I don't find it, I'll pick another topic. But come back after the break, and hopefully I can find it on the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Well, I couldn't find my article. So it was there and then it's gone. It's been Google hold, I guess. Anyway, it was an interesting article about economic dynamics and how we, kind of the reason that sometimes there's this big disconnect between what we think about the economy and what's actually happening. And this was also a good question. I wrote an article for Tuesday for Newsmax. So Newsmax emailed me over the weekend and said, hey, can you write an article about these all-time highs when there's such a big disconnect between the markets and what people think about the economy? If you take a look at polls as an example, what do you think about the economy currently? The approval ratings for President Biden are very low. The economic ratings are very low for the economy. And yet markets are hitting all-time highs. And you would think there would be some type of connection, kind of between those two. If the markets are doing well, then, sentiment should be doing a lot better. And we're certainly seeing improvements in consumer sentiment. Those indexes, like I said, were up sharply here over the last, month or so. But, again, there's still a bit of a disconnect between what happens in the markets and what happens in the economy and how we feel about it. And again, one of the overriding issues, of course, is that, roughly about 86% of the stock market is owned by the top 10% of income earners. So it's a few people. And again, if you're listening to the show right now, it's probably because you have money invested in the financial markets. People don't normally listen to financial talk shows that much, which is interesting, right? I mean, this is your money. It's the most, second most important thing we have. Our family's first, and then we need the money to support our family. So money is very important, but yet we spend very little time educating ourselves about how money actually works. It was an interesting video over the weekend. It was a young gentleman talking about the lack of education he received in school. And that, and specifically graduating high school, not college. He was talking about what you learn in public schools. And, he was talking about that, school never taught him, while school taught him, Pythagorean's theorem, which he will never use in his life, most likely. he didn't learn anything functional about being a citizen, right? And balancing a checkbook or understanding the, how credit works and understanding what a credit score means and, how to buy a house, all these kind of very basic financial things that we should know, right? We're not taught. And so we go out in life when we make all these really bad financial mistakes because, the banks constantly, every day I get credit card offers at my house, right? So for somebody who doesn't understand the impact of credit, instead of those envelopes going immediately in the trash, they get opened. And so we make all these bad mistakes. And then we wind up in a position, and there's another good article over the weekend talking about buy now, pay later, and we've talked about the issues with buy now, pay later. Those bills are now coming due for many of these individuals that rack them up over the Christmas shopping season. There was a video of a comedian. She's a young comedian, and she was lamenting the fact that she spent $1,500 on her family over Christmas on buy now, pay later. It sounded like a really good opportunity at the time. Hey, I buy it now and I just make 4 easy payments, over the course of the next year. But now she's $1,500 in debt. She's like, I don't know where the money's coming from. Because now the bill's here. And this is always the problem with this. And so, what happens, for the vast majority of Americans, that 80% of Americans that don't have any money really invested in the financial markets to any great degree. They're living paycheck to paycheck. They have no cash flow. They're massively in debt. You ask them what's going on in the economy, it's a vastly different opinion than the people that have money invested in the markets. Like, oh, it's great. Man, market's hitting all-time highs. I'm doing great. I'm making money. It's a big difference. And so when we take a look at a lot of this economic data, we have to be careful with understanding that it's impacted and skewed in many measures by the top 10% of income earners. We talk about, debt to income ratios or savings ratios, et cetera. There's a big difference between a person that, is actually able to save money versus the large number of people who can't. Debt and savings ratios for the bottom 80% are very different than those in the top 10%. But because the top 10% skew the data because of wealth and net worth and those type of things, especially the top 50%. And really, if you kind of look at the strata of the breakdown of net worth, and this includes the value of your house, right? So once we start including the value of a house, it's a little bit different picture than just the stock market. But even once you include the value of the home and the net worth, the top 10 and 20% of the strata make up a very big chunk of that household net worth. It's also the area where it's grown the most. For the bottom 50%, their net worth has not grown much over the course of the last 30, 40 years. It's grown some, but not tremendously. So as is always the case when we talk about, well, how is the economy doing? It's doing great for some of us, right? But for a large number of people, it's not. And there's a very big disparity. Again, if you're, I was talking about on Friday when I was, talking with Adam Taggart, is that, if you take, there was a recent poll out and they listed the top 10 most watched podcasts, right? Or shows on YouTube, true crime, those type of things. Those are the ones. And my wife loves true crime. She's been plotting to kill me for years. Funny story real quick about her. Last night we're at home and she's getting older and she refuses to go to the doctor and get eyeglasses because she just doesn't want to wear glasses. And so, her vision's getting a little more farsighted as she gets older. And we're at home watching a show last night, which, and the guy picks up his phone, and on his phone is a text message, and the letters are just huge, and they had made the letters big on the phone so it would pick up so you could read the text message, in the movie. And she's like, why is his text so large? She goes, mine aren't that big. I can't even read the text on my phone. I said, well, honey, you have a phone? I said, if you just click on a text message, you can expand it. And she clicks on a text message and she's trying to expand it and it won't expand. And I'm like, she's like, it doesn't work. And I said, is that an Apple? And she's like, yeah, that's my Apple. I said, well, try your Android, because she has two phones, one for work and for personal. And so she gets on her Android, she tries it there, and it won't work on the Android. And I said, well, it works on mine. And so I showed her, I said, look, so I pulled up, it was actually a text message from Brent. And I was expanding it and reducing it. She goes, mine doesn't work that way. And I said, honey, yours is already expanded as far as it can go. and she goes, well, it's just not fair. It's not as big as the one on television. But anyway, the problems of getting older and having to read things up close. Yeah. It's always, people are getting more creative too at restaurants. You'll see them. They'll take a picture of the menu with their phone and then expand the picture on their phone. Yeah. That's why I went to Dr. Whitsitt and fixed that problem. Yeah. So anyway, I digressed. Anyway, there's this big disparity, kind of like messages on the phone, between what people actually see in the economy and what's actually happening. And this is one of the things that we'll have to continue to deal with this year as we move forward is when we see this data, understand that there, again, and this is going to be a big part of the election coming up this year as well, that Greg will be talking about this Saturday, is the people's view about the economy, because it's, when you take a look at the top 10 podcasts that are watched on YouTube, finance isn't even on the top 10 list. People aren't educated about finance. Now, again, if you're watching this show, it's because you've got money invested in the markets. It's important to you. And so you're trying to learn about what's going on and keeping up with it. And that's great. And I applaud you for that. But you are definitely in the minority. For the vast majority of people, they don't watch finance shows because there's nothing relevant to them as to what's happening in the financial markets. It doesn't affect them on a day-to-day basis. They're just trying to pay bills. They're just trying to live their life and raise their family and do their job, and they're not coming home to listen to a podcast on finance and markets and the economy, and it's stuff that we don't teach. And so for most people, it just goes right over their head. It's just stuff I don't get it, right? So I'm not even going to pay attention to it. The other side of the reason is, of course, is that they don't want to deal with it because it's depressing. So it is what it is. But anyway, so over the next, we'll talk about this more on Saturday as well at the upcoming summit. If you haven't got your tickets yet, you can do that online at the website. But, this is stuff we're going to be dealing with all year, is talking about this is what the economy says, this is what the market's doing, and those aren't necessarily going to be connected because of liquidity, spending, all these type of things. Anyway, if you haven't read the article on the website from Friday about deficit spending, keeping the economy out of a recession, it's worth a read. There's lots of charts in there, of course, as always, kind of supporting what's happening in the economy. All right, wraps up the show for today. We'll see you back here tomorrow. We'll talk about what happened in the market today tomorrow. See you then.